First of all, it's focused on DXY. DXY, which everybody uses as the stand-in for the dollar, it's not. DXY is a stand-in for the euro US dollar exchange value. And even that is overstating things a lot to begin with. But you look at a number of different currencies and you can see the same thing. The dollar made a huge move, and I mean huge move last year, which was consistent with, rising illiquidity across the system, more safety and liquidity demand, interest rates, steepening on yield curve, bull steepening on yield curve. It's not something people get wrong, what's going on in the yield curve. So you had a major dollar disruption last year, which sent the dollar soaring higher. In fact, it soared to extreme values. Even DXY got up to, I think it was close to a record high, when some of the other broader trade-weighted indexes did set record highs, especially the trade-weighted index against emerging market currencies, which definitely hit record highs, which is consistent with a period of tightening dollar conditions. We got to extreme levels in April, as you would expect, given the disorder and chaos. And then after April, all that happened was the dollar relaxed from those extreme levels. So the dollar was way up here, indicating extreme illiquidity, extreme levels of fear and risk aversion. Then they came back down a little bit. The DXY was accelerated and amplified because the euro went down more than others. And everybody said that was sell America. It wasn't sell America. You look at currency after currency after currency, all that happened was the exchange value retraced to where it had been before the big spike in the US dollar that started late last year. So like the Canadian dollar sunk way down to not quite a record low, but it sunk down to around 2020 lows. And then it came back up. It wasn't a weak US dollar. That was the US dollar, Canadian dollar exchange value going back to where it was off of the extremes from March and April. Then we got to July, and you can see this in a whole bunch of currencies, including the euro. The euro hasn't been going up at the same rate as it had before. But you look at all these other currencies, Canadian dollar, New Zealand dollar, Indian rupee. Indian rupee is a big one. Korean won, a whole bunch of, even the Japanese yen. The US dollar is making starting to rise again ever since the early part of July. And some of these currencies are sinking down to not just multi-month lows, but getting back to where they were closer toward April rather than something like the US dollar falling in value. So the dollar is actually making an upswing here, and it's starting to accelerate higher in some of these key currencies, like the Indian rupee continues to hit record lows. The South Korea won, which was sort of a measure of potential for tariffs and trade wars and the negative impacts that those might have. The Korean won is back below 1,400 to the US dollar, despite the Korean government intervening at the end of August. So the US dollar is moving higher again, which would be consistent with a world that is moving toward low interest rates and low copper to gold deflationary environment. And so if we see the dollar continue to rise, which I think it's starting to signal the next stage in this cycle playing out, again, it gets us closer to that end point where we get into that last mile situation. And if we do have, not just U.S. shadow bank credit that starts to become more and more questionable, but more global credit profile that becomes more and more questionable, you'll see the dollar continue to go up in exchange value, which is not a good sign. Has nothing to do with politics. It has nothing to do with all the mainstream narratives about what the dollar is doing. The dollar going up is just a financial bellwether. And if the dollar's going up, that just means tighter financial conditions. And if it goes up by a lot in a very quick paced fashion, that tells you that there's more of acute financial negative financial conditions.